Hello everybody. I'm going to talk a little bit about the independent study I've been working on here at Wharton to enhance the Sharpe ratio on carry trade returns. So first what I'm doing is I'm loading in some data here. This is a UI built in MATLAB. We're going to start by looking at the yen-dollar cross. So here's just some basic data like the relative equity market returns in Japan and the US and the spot currency rate. This is the forward curve on the currencies on the yen-dollar. And then this is the forward rates, interest rates in Japan. And so these are kind of the data that we'll be using to build kind of our excess return on carry trade P&L. So you can see this is what you would have gotten if you did this carry trade at various tenures over the last 30 years. We'll also be looking at things like TED spread, term spread, and current accounts in our model. And again, the goal of our model is to enhance the overall Sharpe. So it's kind of toggling when we're hedging and not hedging in the local exchange on our carries. So here's kind of just the model. It's identifying bulls and bears using a probit model. And the in sample is the 80% of the data to the left of that black line, and then to the right is out of sample. And we're trying just to predict times when we don't need a hedge due to depreciation in the currency. You can see the performance here of, basically predicting when you're safe to do the carry. Creates a massive outperformance relative to if you were just hedging 100% of the time. And again, we can look at other things besides the yen. The franc is another good funding currency. And again, that has its own data set here. This is the rates curve and the relative equity returns over time and the excess returns you're getting on that carry trade. The interesting thing here is in the spot rate market, there's these big, moves by the central bank where there's a lot of volatility, and the model has one of those in sample that it's fit to, and so it predicts when it happens again out of sample, it knows to get shorted right away. It doesn't predict that the central bank was going to act, but as soon as the central bank did act and remove the peg, it got right in there and said, look, you don't need to hedge the currency anymore, take your hedges off, which I thought was interesting. We can look at kind of EM, which is a little different animal. I don't have as clean data on that or as far back, but it's still interesting. You can see the massive swings in the Brazilian forward rate curve here. And the funny thing is that this market's been in currency's been in a bear market for so long that the model just, fits it within the 80% and just continues saying stay shorted throughout the last 3 years. So it's been obviously right on that. And it looks like there's no hope or end in sight for Brazil. So thanks for watching.